Welcome to this Killik Explains finance video. This week, a fairly topical one, I think you'd agree, how cool-headed investors can profit from volatility. Now, we've seen loads of volatility in the markets recently. In the first half of 2018, we've seen quite a chunk of volatility so far, and we're not through the first half yet. So, question is, should you follow the herd and kind of panic, or is there a way to take advantage? Okay, let me give you a suggestion. Now I'm going to cover a lot of ground in a short space of time here, and that's because a lot of the themes here I have covered in other videos. So basically, if you want to know where those other videos are, I'll give you a link at the end, and then ping me an email if you want to know specifically which ones to watch. Okay, so an overview first of all. Bears love to grow out, says on the left. So many investors react badly to what's happened in markets recently, and that's because they panic sell, they overtrade, and they move into cash. In other words, after a long bullish run after the last financial crisis, where markets get volatile, quite a few people just panic. They're not sure what to do, go to cash, get worried, and so on. And that's partly the result of how we're programmed. It's actually not our fault, if you like. I cover this in other videos, but as humans, we are panicked into selling sometimes in the markets because of human behaviour that's hardwired into us from our days on the savannah and so on. However, that's not a good news. There are investors out there who know most people do this and take the opportunity. So what do I mean by that? Basically, there are investors out there who keep a cool head through periods of volatility and say to themselves, well, few companies go from good to bad overnight and vice versa. So actually, is the stock market falling 5 or 6 or 7% in a short space of time? Has that suddenly changed fundamentally the outlook for my favourite companies? Maybe not, all right? Choppy markets sort the wheat from the chaff, what's more. So basically, as Warren Buffett put it, a rising tide floats all boats, right? It's more difficult to get a bargain when everything's toppy and expensive. But period of volatility, maybe you get shares that you love, they're actually marked down too far, too fast. And there potentially is your opportunity. Now, we're not talking about massive market timing and all that kind of stuff. We're just saying that during periods of volatility, surely there could be opportunities to either add to an existing holding more cheaply than you did before, or even buy something you've had on your watch list for a while. That's what we're talking about here. So in other words, certain investors will say, great, I'm taking a long-term view, and right now I can get what I want relatively cheap. So what are you looking for? Now, this varies obviously, but essentially this is ground I've covered elsewhere, so I'm going to keep it short. What we're looking for is good companies at cheap prices. That's sort of the value investor's tenet, if you like. So what is a good company? Well, all I'm going to do here is give you some kicking the tires reminders. So I cover these in a lot more detail in other videos. So we're looking for potentially consistent trends in sales and profitability. And by profitability, I mean gross margins and operating margins. One of Terry Smith's favourites, that one there. And return on equity, another one of his favourites there. We're looking for good cash conversion, the ability to turn operating profits into operating cash flow consistently and to a similar level. So what I mean by that is, a pound of profits becomes roughly a pound of operating cash flow. It'll never be exact other than by fluke, but you get the idea. Strong, stable balance sheets. There are loads of ways to test the balance sheet, F scores and the like. Wide economic moats, as Warren Buffett will put it. So let's check that the firm still has sustainable competitive advantage, keyword sustainable there, and cash flow with reasonably low volatility. And I'm a traditionalist. I quite like positive cash flow in the main, and I like it to be reasonably stable. Now, the flip side of that, companies with weak moats, and I go into that in a lot more detail, why strong firms tend to have wide moats in another video. But sustainable competitive advantage is important. High operational gearing, high financial gearing. So what is that in layman's terms? Operational gearing is a high proportion of fixed costs to total costs. It's not the end of the world. It can trigger sort of exponential growth in good years, but it can be risky when things turn south. High financial gearing is a lot of debt relative to total funding. Low interest cover in a rising interest rate environment, that can be a bit more problematic, both on a cash flow and profitability basis. Volatility in sales, profits and cash flow, it's the flip side of a point over here, and regulatory uncertainty. So in certain sectors at the moment, huge regulatory uncertainty, whether you're looking at blockchain companies, whether you're looking at potentially social media firms, and so on. Now, cheap for the wrong reasons. So this is saying, right, I know I've got a template for finding good firms, firms that I want long term. The question is, I'm looking for the opportunity to get them a little bit cheaper than usual. So What you're looking for is firms that are cheap for what I'd call the wrong reasons. Explain what I mean now. So what would the right reasons be? The market has marked down a company, correctly so, because there's been a lasting change in the firm's competitive position. And that can come about as a result of government intervention, loss of key staff and so on. Yes, it should have got cheaper and it will probably stay cheaper, relatively speaking. A structural shift in a firm's ability to generate profits and or cash flow. All right? So that can, again, come from any number of potential sources, acquisitions going bad, over-diversification and so on. And persistent short-selling interest. Now, short sellers are not always right, but they do take a lot of risk. And in doing so, they do a fair amount of analysis on their targets because they're basically betting they can make money from falling prices. So I do keep an eye on that, even though there are some people that don't. Now, the wrong reasons, and actually this is what we're looking for. So what we're saying is actually firms we like, firms where we kick the tires already, all right, and we're just rechecking that right now, may have dropped because of general market factors. Nothing really to do with them, but trade war talk, some recent examples, actual war talk, North Korea, Donald Trump and so on. Sectoral gloom, you know, people sort of talk about the FANGs having a bad day as though they're all the same. I mean, the A is Amazon, and that's a logistics company. Rather different proposition, I would say, to a Facebook, for example, or even a Netflix, all right, or a Google. So just, you know, people put these broad labels on, the media do it, FANGs down, and actually anyone with a cool head would say, well, hang on a minute, what does that actually mean? Are we talking about really an identical group of companies? Is there an opportunity to pick one or two off if I was looking to add to that holding anyway? Central bank pronouncements. People watch central bank pronouncements like a hawk, correctly so, all right? But does an incremental move in interest rates affect all firms equally? Probably not, and yet you get days where the market just sells off because the Federal Reserve has gone a bit more hawkish, for example. And media speculation. You know, there's rumblings about Brexit the whole time. Classic one at the moment is how many jobs we lost in the city? Is it 5,000? Is it 10,000? Is it 100,000? Is it none? Will we gain a few? No one really knows, but it makes for good media headlines. So that's what I mean by a firm that's on your watch list gets marked down with everybody else, and you're thinking, well, hang on a minute, what's changed for them other than the fact they're now a bit cheaper? Now the big challenge. It's easy for me to say all this stuff. We are programmed to follow the herd, to be loss averse. In other words, we tend to want to avoid losses more than we enjoy gains. There's plenty of papers written on that human behaviour. We tend to look backwards in the short term. If we've had three or four bad days in the market, we're wired as humans generally to think, well, tomorrow is going to be at least as bad, if not worse, when actually it could be completely the opposite. All right? We're fearful when others are fearful. Whereas Warren Buffett said, do the exact opposite, but it's human nature. We tend to equate today's stock market to wider economies. We tend to use the stock market as a barometer of what's happening in the world economy now, and actually that is not strictly the case. Amongst other things, there are huge timing differences. There are all sorts of factors that work in the stock market which don't necessarily mirror the underlying economy, including emotions and so on. And we see volatility as a risk that must be avoided. So a lot of people see the word volatility and think, whoa, that's something I need to avoid. Actually, it's something you need to manage. Now, so a better bet. So wise investors will stick to a long-term investment plan. They'll say, well, I'm not going to just throw the baby out with the bathwater, massively alter my asset allocation to achieve my long-term personal life goals just because the market's having a bad day, a bad month, a bad 6 months, even a bad 2 years, frankly. They look for opportunities to buy when others are selling. Easier said than done. But the point is, if you've got stocks on a watch list, presumably they're still on a watch list unless something has changed, unless they are cheap for the, what I call the right reason, if you like. People accept, wise investors, that volatility is part and parcel of investing. You can't avoid it. It comes with stock market investing. So it's not something to fear. It's not something you can avoid altogether unless you're incredibly lucky. It's just something that needs managing. Now, clearly, if you are somebody who's approaching the point where they need to spend a certain amount of capital, whether that's on an asset like a new car, whether it's retiring, your perspective is completely different and your asset allocation is completely different. As a long-term investor building wealth, short-term periods of volatility are not to be feared and in some cases can be actually a good opportunity. Now, covered a lot of ground there, and just hinted at lots of topics that I cover in other videos. If you want to see, there's other related videos on testing balance sheet strength, red flags, profit trends, cash flow statements, what are those all about? What's a moat? How do you test one? Well, killik.com/learn, in particular, the shares section and the red flag section, plus some of the investing principles, those are good places to go hunting. And if you can't find a specific video, do ping me an email. And to do that, editor@killik.com. Hope you enjoyed that short snapshot, and I hope that basically you can see that volatile markets are not conclusively bad news.